They bought a company for $26 billion using mostly borrowed money. Weeks later, the worst financial crisis in 80 years hit. Their investment lost 70% of its value on paper. Most people would call that the end. Instead, it became the most profitable private equity deal in the history. Today, we are breaking down exactly how private equity works, the math, the risk, and two real deals that ended in completely opposite ways. Now, before we get into the big numbers, you've already done a version of this yourself. It's called a mortgage. Say you buy a $500,000 house, put down $100,000 of your own money, and the bank lends you the other $400,000. You now control an entire $500,000 asset using just one fifth of the money. If the house goes up in value, your small down payment grows fast. If it drops, you're the one holding the risk on much bigger number than you actually put in. Private equity firm do the exact same thing, except instead of a house, it's an entire company, and instead of one mortgage, it's billions of dollars. Here's how it actually works. A private equity firm raises a large pool of money called fund from investors like pension funds, university endowments, and insurance companies. Let's say that fund has $100 million in cash ready to be deployed. Instead of buying a $100 million company outright, the private equity firm goes to the bank and borrows another $400 million. Now they have $500 million in buying power, and they use it to acquire a $500 million company. This is called leverage buyout because most of the purchase is funded by debt, not their own money. Once they own the company, they get to work, cutting cost, replacing management, growing revenue, sometimes even buying smaller competitors to bolt on. The goal is to increase the company's value over 3 to 7 years and then sell it. If it works, let's say they grow the company and sell it for $700 million. After paying off $400 million loan, they're left with $300 million, which is triple their original $100 million, at 3 times returns. If it doesn't work, say the company struggles and they can only sell it for $350 million, that's less than the $400 million they still owe the bank. Their entire $100 million investment is now gone, completely wiped out. And here's the part almost nobody explains clearly. That $400 million loan isn't borrowed in the private equity fund's name. It's borrowed in the company's name. Legally, the company they just bought is one responsible for paying it back, not the private equity firm. So if the deal goes wrong, the private equity firm loses its $100 million and walks away. But the company is the one left holding a mountain of debt it has now to pay off using its own future cash flow, regardless of whether the private equity firm's bet succeeded or not. Small equity check, massive borrowed leverage, outsized win, and outsized loss. And the company absorbs the downfall either way. Let's look at two real deals that show exactly how different this can play out. In July 2000, Blackstone, one of the largest private equity firms in the world, bought Hilton Hotel for $26 billion. Only about 5.6 billion of that was Blackstone's own money. The rest, over $20 billion, was borrowed. Just months after the deal closed, the 2008 financial crisis hit. Travel collapsed, hotel revenue declined. Blackstone was forced to write down the value of its investment by roughly 70%. Internally, this deal was considered close to a disaster. Blackstone brought in a new CEO, Christopher Nassetta, right in the middle of the chaos. He moved headquarters, rebuilt company culture from the ground up, and made one major strategic shift. Instead of Hilton owning and operating expensive hotel real estate, they pivoted to an asset light model, letting other companies own the building. While Hilton focused on the brand, the booking system, franchise, and management fees. This meant Hilton can now rapidly grow without needing huge amount of capital for every new hotel. It took years, but by 2013, Hilton went public again. the largest hotel IPO in the history, valued $7 billion higher than what Blackstone originally paid. Blackstone gradually sold off its shares over the next several years, and by 2018, when they have fully exited, they made approximately $14 billion in profit, nearly tripling their original investment over 11 years. It's still referred to as one of the best leveraged buyouts ever completed. Now, the other side of the story. In 2005, three firms, KKR, Bain Capital, and a real estate firm, Vonando, bought Toys R Us for $6.6 billion. Just like Hilton, most of it was borrowed. Over $5 billion in debt loaded directly onto Toys R Us itself. That debt meant Toys R Us now had to pay roughly $400 million every single year just in interest. Money that could have gone towards modernizing store, building an online presence, or competing with Amazon and Walmart instead went straight to debt payments. For over a decade, the company limped along. It wasn't thriving, but it wasn't collapsing either. As recently as 2016, it made up to 20% of all toy sales in the US. But the debt gave it no cushion. When holiday sales underperformed in late 2017, there was no room left to absorb the hit. Toys R Us filed for bankruptcy, and in 2018, the company liquidated almost all of its US stores. 30,000 employees lost their jobs. Most received no severance at all. Here's the twist that makes people genuinely angry about this one. Even though KKR, Bain, and Vonando lost most of it $1.3 billion they originally invested, they had been collecting advisory fees from Toys R Us every single year they owned it, an estimated $460 million total, taken directly out of the company while it was already drowning in debt. So, even in the deal that technically failed for the private equity firms, they still walked away having profited from fees, while the employees who built the brand walked away with nothing. Same exact playbook: small equity check, massive borrowed leverage, and all the debt sitting on the acquired company. One time, it built one of the most profitable hotel turnarounds in the history. The other time, it bankrupted an American icon and costed 30,000 people their jobs. This is why private equity is one of the most debated forces in modern business. Done well, it can genuinely rescue and rebuild a struggling company. Hilton is the proof of that. Done carelessly or purely for fees, it can hollow a company out from the inside, while the people who structure the deal are protected from the downside. Now, next time you hear a company got bought by the private equity, you'll know exactly what that sentence actually means and who is really taking the risk. Now, if you learn something from this, subscribe. We are breaking down how the financial world actually works, one real deal at a time.